what's happening in the US equity markets, even though that cheer is not quite rubbing off on us, or rather was rather short-lived. Alan Blinder joins in the show right now. He's the former vice chair of the Federal Reserve, professor of economics now at Princeton University. We also have with us James Knightley, chief international economist at ING Manhattan, joining in on the show right now. Gentlemen, both of you, and I should say good evening. Alan, let me start off with you. I think, more than the 25 bips cut we were just chatting about here in the studio, what stood out really was, Powell saying that I'm not going anywhere, I'm going to be staying put.
He has. Are you hearing me now?
Yes, we can hear you.
He has said that before, and you should need to take him at his word. He's in a position which he holds, I'm forgetting the exact language in the law, but on good behavior or something like that. He is not subject to removal by the president until, of course, his term ends. And then the president has every right to name a new chair. As, by the way, President Trump did in his first term. The man was named Jay Powell. He put him in that office.
Alan, how should one read into the commentary from the US Fed, especially the choice of the words where they're clearly indicating that things are looking up for the US economy? And sir, you know it better than anyone else that Fed has got their view on inflation and the US economy wrong. So this time when they are commenting on the US economy, I'm sure they are more than certain.
Well, I'm sure they're never certain, but things are looking good. Economic growth, real GDP growth, say, is a broadest measure, has been doing better than almost anybody would have thought a year and a half or 2 years ago that we'd be doing at this late stage in the recovery. And inflation is tracking down. The core inflation is not quite where the Fed wants it to be, but headline inflation, overall inflation, which includes food and energy, is almost exactly where the Fed wants it to be. So, if they were a more celebratory group, people on the Fed are very sober-minded and serious. But if they were more celebratory, they'd be celebrating the soft landing right now.
James, are you a bit surprised that we've not seen any kind of a reaction in the bond market or a significant reaction in the bond market, even though Fed has cut rates? I mean, bond yields are going higher, even though when Fed is cutting rate. Economic history tells me that it should be the other way around. When central banks are cutting rates should be going lower, James.
Well, I think we have to consider the backdrop that we've got going on right now. It's markets are trying to digest what a Trump presidency may mean. We've seen some huge moves over the recent weeks as well. I mean, we've seen an 80 basis point rise in the US 10-year yield. So that's a huge move in a relative short pace of time, during which the Fed has cut rates 75 basis points. So I think the Trump trade, as it's so called, is certainly in play here. And that sense that we may get a slightly stronger economy in the near term. We've had a clean, clear election result. That may allow some companies that perhaps have been a little bit cautious looking at the election, worried about what it may mean. Well, that certainty is, we've got that clarity now, and that may start to see people putting money to work once again. Investment that's been put on hold, hiring that had been put on hold could well come through. So that may well be a factor in the market's mind. Also, of course, there is this concern about this so-called trade war as well. Will we get the tariffs coming through aggressively and rapidly? Will that have a damaging implication for inflation as well? So there's quite a lot of factors going on in the market. So we are seeing some quite, I guess, what you might term unusual moves, but we have to look in the context of the broader sense of things happening all at the same time.
Alan, how do you think this regime of Trump is going to be? Because the fear in the market is that the government spending would actually increase. That's going to lead to increased borrowing, and that's going to push up bond yields even further.
Yeah, it's not so much government spending is going to increase, though there will be some of that. There always is. But taxes are going to be cut now. And unless the Democrats hold on to the House, which is still possible, but probably under a 50% probability, and manage to block the Trump tax cut round 2, Let's suppose that doesn't happen. You're going to have a large increase in, it's going to be another tax cut effective at really in 2026 because the current provisions expire at the end of 2025. So that's going to mean bigger deficits, more government borrowing, et cetera. And then, as was just mentioned, the big worry, I think the biggest worry on the economic front is the trade war. You know, you may remember that Trump in his first term said, trade wars are good and easy to win. They're not easy to win. I think if he was, there are no winners from trade war, let's put it that way. What you can do if you're the 800-pound gorilla on the block, which we are, is inflict more pain on others than you suffer yourself. That's a strange definition of winning to me. It means both economies or all the economies that are involved take a hit. And Trump has the authority to do that. He doesn't have to rely on votes coming out of the Congress, and there's every reason to think that he will do that. So that should, I think, be on the top of everybody's worry list, economic worry list about the United States. There's plenty on the non-economic worry list as well.
James, I'm coming right back to you, but Alan, I do have a follow-up question for you, which is that in your view, Alan, how do you expect Trump 2.0 to be different from Trump 1.0?
Sorry, could you say that again? I didn't
right.
quite
How
get
do you see the Republican regime different from the Republican regime of last time, which is when Donald Trump was elected for the first time in 2016, the first phase of 4 years versus the coming phase of 4 years? How do you think they could be different, Alan?
Yeah, I think that's a very good question. Two principal differences, and they're both related. One is that in his first term, early in his first term, he was surrounded by what you might call sensible people like Gary Cohn and Kevin Hassett and other people like that. So in terms of who's whispering in his ear, those were people that were conservatives, but you wouldn't really worry about them telling him crazy things. He's basically vowed not to have people like that around him anymore. None of these conventional Wall Streeters or people from the deep state and so on. And that's worrisome. He was better off. Early Trump was better than late Trump in the first term. The other thing that's different and even much more worrisome to me, but especially outside the economic realm, is he's learned how to pull the levers of power, and he's unscrupulous. He said that he will be unscrupulous about pulling them. So he may do things. The tariff war is a great example. That's something he's learned that he could do even more than he did in the first term. You know, almost every economist on earth will say, don't do that. That's not going to be good for the United States, and it's not going to be good for the world. But he doesn't care. As you know, he said many times in many contexts, all those other people, 1,000 of them, 10,000 of them, it doesn't matter. They're all wrong and I'm right. That's the way he feels about things. And now he's more determined than ever to put those feelings into action.
Yeah, it's going to be an interesting one, this regime, and let's see what kind of impact it has on emerging markets and specifically India as well. But Alan,
if you like this video, then like, share and subscribe to ET Now.